All right, let's stay, of course, on this. The venture capitalist community continues to reel in the wake of SVB's collapse. So what's next for these upstarts? We're joined by a pioneer in the VC space, Primetime Partners chairperson and co-founder, as well as Greycroft co-founder and chairman emeritus, Alan Patricof. Alan, great to have you on here this morning. Just have to get your thoughts on the past couple of days we have seen in the venture capitalist community.
Well, it's certainly been a roller coaster. Provided, I would euphemistically, jokingly say, entertainment for a not very relaxing weekend. I mean, this in a way has been a long, long time coming. I mean, it's been brought on by exogenous factors that have nothing to do with the basic fundamental of venture lending, which is really what SVB and Signature and many other banks around the country, particularly in the West Coast, have been doing, which is lending to venture-backed early-stage startups, which are, by their nature, startups in high risk, with many of them without significant revenues, and providing lines against those to those companies, which were, in my opinion, totally justified or totally explained, that's a better word, by their assumption that the venture capitalists who backed the equity of these companies, to whom the banks were extending lines, would come in and supply equity capital almost before the bank lines would be drawn down or simultaneously with, and that in the meantime, they were getting huge deposits from the financings these venture capital backed companies had done. And it was really a kind of lending that in 40, 50 years ago, before SVB, would have been called senior preferred type financing. And SVB came in and invented a whole new concept of what they call venture lending, which was to make loans out of things that would have normally been senior equity. So, but that in the end isn't what tipped them. I gather it was because they went long on their maturities and they couldn't deal with their short-term demands of these lines being drawn down, and it created a very dramatic, quick mismatch. And of course, they have the deposits of every one of these companies, and as it has been stated, and is absolutely true, there are thousands of companies who have deposits with these banks, which are perfectly legitimate deposits, and the banks' the deposit assets were perfectly fine, but all of a sudden they're put in jeopardy because of the bank's own problems.
Right, and Alan, just to be clear here. You guys are based in New York, I believe, but obviously you're in the startup business as well. Did you or any of your portfolio companies have money at SVB? And what now sort of happens to the wider community as a result of this bank going out of business?
Well, you were asking me a question, which I've been in the venture business 52 years, and to say I don't have any investments that are affected by this would be ridiculous. Right. We have, going back, 40 years ago to when the SVB started, many of our companies took advantage of lines and from these banks and gleefully called down on those loans. And many, we have a portfolio, fortunately, is not in prime time, is I'd say almost all our companies have not drawn down on their line. So they're sitting there with deposits in these banks, but for those who used any of these banks, and that was limited, and limited size of deposits and limited size of exposure. They are now in a position like every other venture-backed company that is expected to draw down on lines as part of their financing plan, are now going to have to, and that's the key thing here now. I mean, they are going to have to look for alternative sources of capital, because my assumption is that this type of lending is going to change dramatically, and that banks are going to be very, very cautious about lending to early-stage startup companies under the assumption that they're traditional, in quotes, loans, if you will. And I think that it's going to open up the need for convertible debt financing from other types of lenders or investors, I should say, or the preferred stocks. But it's going to take more of an equity characteristic to it and not require loan servicing and repayment, which traditionally venture loans that were made by SVB, Signature, and all the others, by their character, required at some point. So I think that's going to open up opportunities for new types of investors, and at the same time, I am sure that the terms are going to become much more severe and more appropriate to the risks that are being taken. They'll have a senior characteristic to it, but it'll be a senior equity rather than disguised as venture debt, unless there are firms that have venture debt that have assets and have revenues and maybe profits, and where the SVBs and Signatures were going to make a lot of their money was not just from the loans and the interest rates, but from the enormous amount of warrants that they got in each of these companies. So when they made extended a line, they were getting warrants and they were also getting deposits. So, as long as the system kept working, it made sense, and that's why the banks were prospering in the market. Now it's all come home to roost, and for reasons that had really nothing to do with the fundamentals of the businesses. They didn't overnight change what they were doing. It was really the bank's problems.
Alan, how concerned are you that what the Federal Reserve is doing in terms of raising interest rates and going back to see how far they have raised interest rates already this cycle, how concerned are you that their efforts will make this situation worse?
I don't have any insight, nor does anyone else on this show. I would guess that they would not raise this, and at this particular moment in time, I'd let things rest for a while. I let the banking system find a level that is comfortable, and excuse me, that the market's opening. It just evidently opened 2 minutes ago. I'm not watching the tape in any way. We're going to see, how the system adjusts to itself. I think a lot of people, I'm certain a lot of companies are now going to test the ability to, get their deposits to the extent that they need them, just to make sure that they really can access them. And secondly, people are going to test to see the lines they have really are there, maybe even if they don't need it. So there's going to be put pressure, and I think the Federal Reserve has said they're going to make liquidity available so that a lot of companies, let's say a young company is a very early stage, losing several $100,000 a month, has a few $1 million in cash in the bank. My guess is they'll access their line, wherever the bank line is, and draw down some $500,000, $1 million. I would doubt whether they go draw their whole line down and see if really the wire transfer comes through. And, I think over the next several days, that will probably give confidence that these lines are going to be met where they have been extended. I mean, the Federal Reserve is not going to assume the lines that are outstanding for SVB or Signature or anyone else. I mean, they're going to protect the deposits, which is the right place. Mm-hmm. But if you had a line at any bank today, you're going to have to secure today to find out whether the line is really still good. Yep. And alternatively, if you don't, to seek some alternative type of financing, which may not be, I would doubt whether it will necessarily be what we've called venture debt in the past.
Yep. All right, we'll leave it there for right now. Primetime Partners chairperson and co-founder, as well as Greycroft co-founder and chairman emeritus Alan Patricof. You're always gracious with your time for us. We appreciate it. Thank you.